Okay, so let's continue from where we left off yesterday. Okay, so first of all, let's see the next topic, which is dividends. So only two or three things are left in this chapter, and after that, we'll be moving towards the cap and get questions of this chapter. Okay, now first, let's see what dividends actually mean, and let's discuss the detail regarding the dividends. So dividends represent the distribution of profits to shareholders. They are usually expressed as an amount per share, example 10 cents per share or 10% of nominal value. So yesterday I told you as well that what are actually dividends, that whenever there is a profit share after deducting all the expenses, so the residual profit, what happens with that is that is distributed between all the shareholders. That is basically called dividends, right? So there are difference between dividends, like how they are treated in form of ordinary shares, like what dividends are given to the ordinary shares, and what dividends are given to the preference shareholders. So we'll discuss each and every thing regarding these two. Okay, so first of all, um, let me tell you what is basically the difference. So I told you that there are two kind of shareholders. One are ordinary shareholders, right, and the second one are preference shareholder, right? So what happens is that in preference shares, only the irredeemable ones, remember from yesterday's class, so only the irredeemable ones are treated as equity, right? Those are treated as just normal shares, but the redeemable ones are treated as a normal debt. But we are not looking at redeemable over here, because dividends are only given upon shares, not on loan. Okay, so the preference shares which were irredeemable, they basically have a fixed share of dividends. Okay, so let me explain you in the notes as well. Just give me a minute. Okay, so let's discuss this concept over here. What happens is that as you can see that I talked about two things, right? So one was ordinary shareholders, and then I talked about the irredeemable, irredeemable preference shareholders, right? So these two are treated as equity. These are the only ones, right? So what happens is that, let me tell you what is the priority given to the dividends. So always remember, the first priority for giving the dividends is given to the preference shareholders, because this is an embedded quality in the preference shareholders, that whenever you purchase, if you go to the share market right now, if you ask them that I want to purchase preference shares, then there is a quality in the preference shares that you will get the dividends at first. Okay, and what happens to the ordinary shareholders, they're kept as second priority on the dividend giving. That means that they are given dividends on the last priority. They are not, uh, very much involved in the decision making and all of that. Okay, now what happens is that, let me write the feature over here. They get dividends first. Always they get first, right? Now let's say if the residual profits after deducting all the expenses, it's amounting to, let's say, $2 million, right? And let's say out of this $2 million, $1.5 million are given to the preference shareholders. So how much is left? That is distributed to the ordinary shareholders, because they have the second priority, right, of getting the dividends. So how much amount is left? Only $500,000. So the ordinary shareholders in this case can say that they are unfairly treated over here, because they receive the dividends on the last priority. So that means some shareholders, some ordinary shareholders might not even get the dividends, not at all. Okay, and that what I was talking about when we started the chapter, that in loan what happens is we have to give a fixed interest, but in the shares what happens is that sometimes the shares, sometimes the dividends are missed as well. So Microsoft also did this. This is a live example in front of you, that Microsoft, a very well-known company in the whole world, we use their laptops as well, the Windows 10, Windows 8, Windows 7 operating systems. So Microsoft, what they did is, in old times, they skipped giving dividends for, I think, 7 years, if I'm not wrong. This was the time period. The 7 years they did not give any dividends to their shareholders. That means they only give dividends to the preference shareholders, because they have the first priority, and maybe they did not have some kind of money left that they should still distribute. Okay, so always remember, first priority is given to the preference shareholders in terms of dividends. Let me write over here dividends as well. And the last and the second priority is given to the ordinary shareholders. Now there is one more feature in this last priority. Okay, now there is one more feature in this, and that feature is that, everything, at one point, if you're losing something, you're also gaining something. This is the rule of the world, as you know, right? This also happens in a real life. So if these ordinary shareholders are given the last priority for dividends, the advantage that they have is that they have voting rights in the company. Always remember, only the ordinary shareholders have voting rights over the companies. That means if the ordinary shareholders purchase 60% of the shares, they may have the control of the company. This thing we'll study further in the consolidation section as well, in the consolidation chapter. But the problem with preference shareholders, the advantage of this is that yes, they get the dividends first, but the disadvantage of this is that they don't get the voting rights. Okay, so they don't have voting rights. This means if I go to the share market right now, if I go to the share market right now and start to purchase even 100% of the company's preference shares, I will not be entitled to making decisions in that company, because my talk will not be heard over there. My perspective will not be heard because I don't have the voting rights, because these are preference shares. But if these 100% were the ordinary shares, yes, then I would have the voting rights. So sometimes what happens is that ordinary shares are a little bit expensive than the preference shares, because obviously they have voting rights, which is very important in this case. Okay, so this was the difference that I wanted you to explain. Now let's read it from here. A company may pay a mid-year or interim dividend. The double entry for the dividend, as you can see, is over here. So always remember, dividends are deducted from. I am basically making things simpler. That's why I'm writing over here. So deducted from retained earnings. Always retained earnings. Retained earnings also comes under the equity, under the capital section, and this basically has all the profits. So all the profits that are invested back into the company are contained within retained earnings. It's very similar to revaluation reserve. All these four things are under the capital or the equity section: share premium, share capital, revaluation reserve, retained earning, all these four things. Okay, so debit, we do retained earning. That means we take the dividends out of retained earnings, we pay them out of retained earnings, and we do credit bank. So bank is also decreasing, retained earnings are also decreasing. So this is the double entry you always have to remember. At the end of the year, companies may propose or declare a dividend to the ordinary shareholders. That is, that they tell the shareholders the amount of a dividend to be paid after the year end. So they just plan it. It's not actual. Okay. So this is a final dividend. These dividends to be approved at the annual general meeting, and until this point, the company has no obligation to pay them. Okay, so there are basically two kind of dividends. One is the final dividend that we have to include. This is called the final dividend, and one dividend is called as a proposed dividend. This thing is, although no, I think not written um, in the book, but I'm telling you this. So what happens is that proposed dividend, always remember, this is always ignored in the financial statements and the financial accounts. We have to ignore it. So if the examiner tricks you by giving you proposed dividend and a final one, you will have to consider the final one, but you have to straight away say a big ignore to the proposed dividend. You have to ignore it, because this is the dividend that is actually not paid right now. But yes, the final dividend, yes, it is paid. It is actually paid. Okay, so anything relating to assumption is straight away ignored in financial accounts. So therefore, proposed dividends at the end of the year that have not yet been approved by shareholder cannot be recorded. So same thing is written over here in this statement. All right. Now let's discuss some detail about loan notes as well. We discussed some introduction above in the last class. Now let's discuss loan notes as well. So a limited company can raise funds by issuing loan notes. These are fixed term loans. The term loan note simply refers to the document that is evidence of the debt, often a certificate. Remember yesterday I explained you with the help of a diagram. I made a lot of certificates. So these certificates are given to the investors as a valid proof, as a written proof that they have invested, and the company has to return them some kind of money. So it's like the investors have given the loan to the company. It's not bank. Okay, so similar to shares, the loan note will have a set nominal value. So it will have some kind of value, just like currency notes, right? Every currency note has a certain value, like $10, $100, $50, $20, right? So individuals or organizations can buy the loan notes at an agreed price. The life of the loan note will be fixed, and the company issuing them will have to pay the loan note holder back at an agreed point in time. Obviously it's a loan, and I told you one indication of loan in every kind of situation. What happens is that if you need to determine a thing is a loan or not, is it a debt or not, you just see that is the door open for paying back the money, paying back the principal amount. If the door is open, yes, it is a loan, yes, it is a debt. If it is not open, then no, it's not a debt. Like for example, redeemable preference shares. So those are treated as, those are called shares, but they're treated as a debt because they're redeemable. The company has to pay them back at a point in time. Okay, so the issuer will also have to pay interest to the loan note holder. Obviously, instead of dividends, this will now be called interest because it's treated as a loan or a debt. The interest will be calculated on the nominal value of the loan note. For example, 5% of this nominal value, for example, let's say it was $100. Okay, so every loan note will have a nominal value. So let's say if I wanted to invest $10,000, I just had $10,000 extra lying in my bank account. I wanted this to invest in some company. So what I did is that I decided to go with the loan note. I decided to invest in the loan note, and they only had $100 loan note. So what I did is that I purchased 100 loan notes, right? And each loan note had a value of $100, right? So this means that total $10,000 I invested in 100 loan notes. So the number of loan notes, how much they are? 100, and 100 multiplied by 100 is 10,000. Okay, so this is how it works. The interest incurred is included in finance cost in the profit or loss statement as an expense. Okay, now let's see the accounting entries as well, because this is a liability, this is a debt, so accounting entries will be very, very simple. So when finance is first received by the company, receiving the finance must recognize the obligation to repay the loan. So what is the first double entry that we made? Obviously, we are the company, we are receiving the cash, right? So the cash of our company will increase because investors are paying us. So debit cash and credit non-current liability. So it's just treated as a loan. There is no difference between loan notes and a loan. Okay, now for the finance cost, obviously we have to record a separate double entry, and that is debit finance cost or finance charges, which are brought into the profit and loss statement, and credit we do cash. Why we do credit cash? Because we are paying out cash, right? Obviously we have to pay fixed interest on a fixed point in time to the investors that invested in the company. So it is exactly treated same as normal loan. There is no difference between them. Okay, we'll just skip this example. We'll jump straight onto the kit questions because they are more reliable in this case. Okay, now preference shares, it's again discussing the preference shares which we already discussed. Let's see over here. So if preference shares are redeemable, we already discussed this in the start as well, they are treated the same as loan notes, right? They are recorded as a liability. So redeemable are equal to liability, right? And dividend payments are treated same as finance cost. But if preference shares are irredeemable, they are treated exactly as ordinary shareholdings, as equity. Remember the treatment I told you yesterday. So redeemable are equal to liability and irredeemable are equal to equity. Okay, it's very simple. Okay, so again, we'll jump on straight to the questions. I don't think there is need of doing this example. Now, there are other reserves as well. That the thing I was telling you about, that apart from share capital and share premium, equity has basically four items: share capital, share premium, which we have already studied above, and the two other things are revaluation reserve and retained earnings. So it's talking same about here as well. In addition to using loan capital and share capital, companies can also use the capital created internally to generate wealth and reinvesting it back to the business. Yes. So instead of issuing shares, two readily available options are available if the company has available cash, and those are either revaluation reserve and retained earning. So some companies in real life as well, some companies use this retained earnings as well for financing. And I told you, what does retained earning contain? It contains the previous profits that are reinvested back into the business. Okay. Now, these capital sources represent the profits made by the business and the inflation in value of tangible non-current asset recognized in a revaluation. So revaluation reserve is basically, you can say, it's a non-distributable reserve, because I told you when we studied the IAS 16, this is a non-realizable. It's an unrealizable concept, right? Because what happens is that we have actually not earned any money. We don't have any physical cash for revaluation reserve, right? It's just an increase in value. We have actually not sold out the asset. Okay, so they are referred to as reserves or other components of equity. They are included in statement of financial position under the equity section, and also they are included in the statement of changes in equity. Again, regarding this, you will be more clear about this when we start the financial statements chapter. So revaluation reserve records the unrealized gain. Again, the key word over here is unrealized. We actually don't have the physical cash. It's just an increase on paper, in just an imagination. On revaluation of property, plant, and equipment, this cannot be paid out as dividend. So we cannot do this mistake that we pay out dividend from revaluation reserve. Obviously, we cannot pay, because revaluation, it does not make sense to pay out dividend from the revaluation reserve. Actually, the dividends are paid from which reserve? Retained earnings, that I already discussed above. So this records retained earnings, records the total of net profits and losses earned or incurred to date that have been retained within the business. So they have been reinvested back. Okay. These can be, yes, these can be distributed as dividends. So whenever there is a question that from which reserve do we distribute dividends? So the answer would be retained earnings, never revaluation reserve. Okay. Right. So this thing you can also read. This is very simple. Now let's come to the last thing over here, which is a small topic. It's also very simple. It's related to this one. This related to the financing, capital structure and all of that we study, but it's about income tax. Okay. So the detail for this, you will study in the exam F6. Okay. Right now in F3 as well, we have studied one kind of tax, and that was, if you remember, it was sales tax, the input tax and output tax. If you remember, we studied it in, I think, chapter 5 or 6 in the start, right? But this is not sales tax, this is income tax. So whatever financing or income or cash the company is receiving, this is the tax on that. Okay. So let's first talk about the sole trader and partnership, and then we'll look at limited liability companies, because both have their own way of recording. So in case of sole trader or partnership, the tax charge is imposed upon the individual rather than the business. Yes, this is a very important point to note. So in reality, in actual world, what happens is that in sole trader and partnership, the tax charge is levied on the individual that is working. So for example, if in this partnership there are 4 partners, so each partner will be liable for their income tax that they have to pay. The company will not be liable. Okay, this you have to remember. Consequently, if the business bank account is used to pay what is a personal tax liability, it will be accounted for as a form of drawings made from business by the owner. Yes, obviously, it makes sense, because if the business bank account is being used to pay off this tax liability, then this will mean that this is some kind of a drawing, right? Because drawing, as you remember, the meaning for drawings was any kind of money taken out as a personal expense from the company's capital, right? So same thing, everything is linked over here. So there was not much discussion for the sole traders. The main topic over here is limited liability companies. There are 3 or 4 steps for calculating the liability. This may be tested in the exam, I cannot confirm, but again, if you try to memorize this, and if you try to have a correct understanding of this, this will be very important and very beneficial for you. In the case of limited liability company, as it is a separate legal entity, we discussed this concept as well, if you remember. If it generates income, it will be subject to tax, obviously. Consequently, the tax charge must be reflected in the profit or loss statement, because it is an expense, obviously, right? And any liabilities outstanding must be reflected in the financial position. So we move on basically, first of all, liabilities, and whenever the liability period is over, we just pay the expense. So expense is also being recorded, and as well as liability is also being recorded at the same time. This is normally referred to as income tax, as it is a tax charge on the income of the company. Okay, so sales tax was different, income tax is different over here. So in the UK, this was traditionally referred to as corporation tax in the start, obviously, but is now more commonly used as income tax. So corporation tax was the old word for this. It should not be confused with the income tax paid by individual employees on their salaries and other earnings. So that is separate thing. This is the income tax for the companies, not the individuals. Okay, so remaining items you can read yourself. This is not much information. The main information is over here. The steps that we're going to discuss. The main thing is over here. Okay, so what are the steps for recording? Let's see. So step number 1, at the end of the year, a company should make the following double entry for its estimate of tax liability. Okay, so what happens is that whenever a financial year is ending, the company makes a estimate, the double entry for estimate, because obviously right now we don't know what is the actual liability, right? So every company moves on estimate. So estimate is a key word over here. So it's basically called the income tax estimates. Okay. So what is the double entry for that? Debit, we do income tax charges, which goes into the P&L. So this is the expense. And at the same time that I told you just 2 minutes ago, that we are recording expense and liabilities at the same time, right? So credit, we do income tax liability, which obviously goes into current liability. Okay, because it's within the 12 months. That's why. Now, what is the step number 2? Following the year end, the actual liability will be calculated and paid. So now the time has come for calculating the actual liability. So what happens is that debit income tax liability, we finish the liability now and we actually pay the cash. So it's same that we studied about the purchases as well. First, what we do is we make an entry for debit purchases and credit payable, because right now any kind of cash has not yet been paid, only goods are received by us, by the supplier. Okay, now when actually the cash will paid, we will finish the liability first, right? Debit payable will do, and what we'll do is credit cash. Now actually at this point of time the cash has actually been paid. So same thing, exactly copy paste, same thing is happening over here. Okay, so two things are compared. First of all, what's being compared? That estimate, always remember, estimate is compared estimate is compared to what thing? To actual liability, right? And now we're going to step 3, which basically explains what is the difference between them, the estimate and actual. Okay, now it is unlikely the actual charge will match the estimated liability, obviously, because estimate is an uncertain amount. It is just an assumption, it's not actual, right? So actual amount can differ from estimated liability, right? So tax liability account will be left with a closing balance carried forward. This needs to be removed as the debt has been settled, obviously. So these two things are called over provision and under provision, which is over here. Okay, so these two things we're discussing right now. Again, I'm repeating, first, in the first step we record an estimate, in the second step we actually pay the cash, right? And in most cases what happens is that there is difference between these two amounts, right? And the difference between these two can be either called over provision, okay, and it can be called under provision, both things. Okay, now let me explain in my own words what actually over provision and under provision means. Okay, now first let's see what is over provision. So over provision in easier words is, as you can see from the word over provision, you have made the estimate very high. You have, because provision, remember from the last chapter as well, provision literal word in English means that we have estimated something, right? Always it's not liability. We provision means that we have estimated, assumed something, right? So the assumption we made is very high. That means the provision is very high, right? So let's say in this case, the estimate is greater than actual. So the estimate liability is greater than actual. Let's say in this case, we estimated that a liability will be 50,000, right? But in actual, it is just 40,000, right? So what entry did we make at the start? What entry did we make? We did debit. What was the entry over here? We did this thing, right? We did debit the tax expense by 50,000, because this is the estimate, not the actual. Okay, so debit expense by 50,000 and credit liability as well, the tax liability as well, by 50,000. But when we'll actually pay, what we'll do is that we'll just decrease the liability by 40,000, right? We'll just decrease the liability by 40,000 and we'll pay the cash by 40,000, just by 40,000, right? So now you might be thinking that the liability was created with 50,000 and it has just decreased by 40,000. So what about the difference of the 10,000? And that over here is called over provision. So always remember, in over provision, the estimate is greater than the actual, right? So that means we have estimated it higher, right? The estimate, that means the expense was made higher over here. Now we need to decrease the expense. Actually, the expense is just 40,000 over here, you can see. But in assumption, we just recorded it as 50,000. So that means we'll have to bring the expense down over here, right? So what we do is credit expense by 10,000, right? And let's see what will be the debit entry over here. And debit, you can see debit, we do income tax liability over here. Okay, so what we do, as you can see on the debit side, on the credit side, still 10,000 will be left, right? Let's assume this was a liability, the tax liability account. Okay, so 50,000 we created this, and 40,000 we finished this, right? So 10,000 still balance will be left over here, right? This balance. So what about this balance? So we will shift it over here. We'll again do a debit. We'll finish the liability, right? So what we'll do is debit liability by 10,000. We'll finish the liability. So this will be the entry for what? For over provision. Okay, right? So again, you can read all these things from here. Exactly the same thing is explained over here. What it has done is it has credited the income tax charge, and same thing I've done over here as well. Credit expense, credit income tax charge, both mean the same thing. Okay. Okay, now let's discuss the under provision. Let's look at the under provision, the second case. Under provision, again, it's a very interesting topic. I hope you're understanding this. Now, under provision, again, it means that the estimate, in this case, you can see the word what it's telling, under provision. Again, provision means estimate, right? So under means we have made it very low. So that means estimate is very low now. It's the opposite situation. So that this means that estimate is lower than actual liability. So let's say we were just assuming, we were just thinking, we were just doing assuming calculations. Let's say our estimate was 60,000. We were saying that, yes, I am pretty sure that my liability of this year might be 60,000, right? But when the actual liability came, when the actual was calculated, it was actually 80,000. So we were shocked to see that we estimated just 60. Now it's 80,000. So that means we'll have to pay more right now. So on this point, what entry did we made? We do debit tax expense by 60,000, because for the, this is the step one, right? We are making the double entry for the estimate. So debit tax expense by 60,000 and credit the tax liability by 60,000, right? We increase the expense as well. We increase the liability as well. Now, when we got to know that this is 80,000, so what we'll do is, this is the thing that we'll do. Look, what we'll do is debit liability by 60,000, because we created it with just 60,000. So we'll finish it with 60,000 as well. We can do 80,000 over here. Okay. And what we'll do is credit cash, but cash actually we paid how much? 80,000, right? So credit cash 80,000. Now you can see duality concept is not met over here. So on debit, there is a 60, on credit, there is 80. That means on debit, still 20,000 is missing. So in this case, what we'll have to do is we will have to create another expense over here, tax expense, which is 20,000. Now this way our debits and credits will match. This means we will have to increase the expense over here. We will have to increase the expense from 60,000 to 80,000, right? So what will be the double entry for under provision? This will be debit tax expense. We are increasing the expense, right? And at the same time, we are increasing the liability. So credit tax liability. This will be the double entry for under provision. As you can see, it's same over here as well. So debit the income tax charge, which is expense, and credit the liability. We are also increasing the liability over here. Okay, so this was the logic. This is, believe me, this is much better explanation than the study text, because if you read it from the study text, you'll be all confused. Your mind will be revolving all along. Okay, so this explanation that I gave you, it's much better than the study text. Okay, so finally what happens is, as you can see over here, that this is the calculation. So in simple terms, the tax liability on the financial position should only ever be equal to the estimate of tax liability at the end of the year, right? So what we do is, for calculating the actual tax liability, what we do is we do estimate plus minus any over or under provision, right? So you can see that in the estimate, why we are minusing the over provision, because in over provision, remember, we decrease the expense, right? You see over here, in over provision, we are decreasing the expense, credit expense. You can see clearly over here. That's why over provision is minus from the estimate. And if there is any kind of under provision, it is added over here. It is plus over here. Because under provision means we have decreased the estimate. We just made an estimate of 50,000, but in actual, the tax liability was 80,000. Right? So this means 30,000 extra expense will have to be recorded. Right? So this will give us the actual total charge for this year, for this current year. Okay, so this is a very important formula for the actual tax liability, for the actual tax expense for this year. Okay, and in this way, our chapter has finished. There is nothing else remaining. As you can see, the chapter is finished. Now, let's move on to the kit questions, right? And let's start doing the captain kit for this topic. Okay, now let's start with the Kaplan exam kit questions. So we'll do first 192. As you can see, capital structure and finance cost. The questions are starting from here. I think they are from 192 till 205, right? So I'll just do the questions till I think 196, right? So 4 to 5 questions we'll look in this, and remaining questions you can try. The remaining 8, 9 questions you can try, and let me know if there is any issue that you're having. Okay, now these are very simple questions. If you have understood the chapter, they're very simple to understand. So a right issue capitalizes. Remember the word capitalize over here. It's not that IAS 16 capitalize. So over here capitalizes means uses. Okay. So anything which is using something, we can say it's capitalizing it. Okay. So a right issue capitalizes the entity's reserves, which can be a disadvantage as this can reduce the amount of reserves available for future dividends. No, it's completely wrong. You can read it again as well, because you see it's written over here, right issue uses the entity reserves. The bonus issue uses actually, right? If you remember, the bonus issue uses the share premium account, because the loss is offset from share premium in bonus issue. But right issue, yes, it is given on much discount, but it's increasing. The share premium is also increasing. Yes, there is a lot less share premium, but still both things are increasing. What entry we do? Debit cash, credit share capital, right? And credit share premium. So you can see all the things are increasing. Nothing is being used over here. Nothing is being capitalized. So we cannot say that this will reduce the amount of reserves for future dividends, because it's increasing the share premium. And in return, it will increase the share, it will increase the retained earnings, right? So this is completely wrong. This is false. Okay. Now, second one, a right issue is offered to the entity's existing shareholders and is usually at a discounted price compared to now. Till here, all the statement is correct, right? You need to act very smart. You need to act very clever in front of the examiner. Okay. Till here, the whole statement is correct. But look at the last 4 or 5 words. Look, compared to the nominal value of the share. No, this is completely wrong. Because if you remember, the right issue was given at a discounted price than the market value, not the nominal value. Nominal value is the cost to the company itself. So why would the company do a loss with no reason to its nominal value? Obviously, every company will fulfill its nominal value, right? If this statement was of bonus issue, yes, then it would be correct. But in right issue, always remember there is a discount at a market value, not the nominal value, because nominal value is fulfilled in every case. The company does not need to make a loss over here. Okay, so both statements over here are false. Now let's look at 193. Which two items within the statement of financial position would change immediately following the issue of redeemable preference share? Now look, what is the word redeemable? Right? So remember, what was redeemable? Redeemable meant that this redeemable, as you remember, it was debt, right? Treated as a liability. Irredeemable preference shares were equity, but redeemable were the debt, right? So if these are debt, which two items would change? First, let's see. I think first, yes, cash will be received in the business, obviously. Cash will be received. What is the double entry for this? Debit cash and credit non-current liability. This is the double entry, right? For the debt. So that means cash is increasing. And what is the second thing? Long-term debt. So these two things will immediately, the word you see over here, immediately. Yes, finance cost will also change, but this will be after the 12 months, not immediately. Okay. So what the students do is they select finance cost as well, and their answer is wrong. So cash and long-term debt, according to the double entry, these two things will change over here. Okay, got it? Now, next one is 194. The statement of financial position of Cartwright Company shows closing retained earnings of 320568. So these are retained earnings, and this is the closing figure. Remember, in the requirement, we have to find the opening retained earnings. Okay. So what happens is that we have to move back over here. We have to do the reverse working. Okay. Okay. The statement of profit or loss showed a profit of 79285. Cartwright Company paid last year's dividend of 12,200. So yes, this dividend was actually paid, right? And now see what's happening above, and proposed a dividend of 13,500. So I told you that proposed dividends are straight away ignored, right? So we have to ignore this 13,500. at the year end. Okay, this had not been approved by the shareholders. Obviously, if this has not been approved, the shareholders will not know about this, so we have to ignore it. We don't have to record it as a liability. Now, what is the let's see what is the formula. So for finding the closing retained earnings, I'm writing the formula for closing retained earnings, and after that we'll change it to solve the opening retained earnings. So this is the formula. Opening retained earnings, we add the profit in this, right? And we minus the dividends. This is the formula for the closing retained earnings. But in this case, you can see the closing are given in the question, 320,568, right? So we'll do the reverse working over here. Opening retained earnings we read over here. We are calculating, right? How much is the profit? 79285 plus 79285, and minus the dividends. Only which dividend will include? 12,200. Not this one, not this 13,500, because these are the proposed one. We have to ignore it simply. So 12,200 only. Now what we'll do is 320,568 minus 79285. We are just taking these values on that other side of the sign, and plus 12,200. This will be equal to opening retained earnings. This is just simple maths, right? Now let's calculate this. Just a second. So 320,568 minus 79285, right? And plus 12,200. So the answer is 253,483. 253,483. So the correct answer over here is option D, 253,483. Okay, right? Now let's do 195, which is the second last question, because this 196 will be the last one. Or let's do it till 197. Okay, the following extract is from the statement of profit or loss of Gearing Company. Okay, now profit before tax is 68,000, right? And tax over here is 32,000. This is profit for the year. So when we'll study the financial statements as well, you'll notice this, that basically when tax is minused and interest is minused as well, then we actually get the profit for the year, which is net profit. So in addition to the profit above, Gearing Company paid a dividend of 21,000 during the year, right? That's fine. And a gain on revaluation of land resulted in a revaluation surplus of 18,000. So these two things happen. Okay. What is the requirement? What total amount will be required, will be added to retained earnings at the end of financial year? So you can see this second one, this is related to the revaluation surplus. So this does not have any connection with the retained earnings, because we have to find the retained earnings, right? This is a separate reserve. Revaluation, basically, this is just irrelevant to this chapter. This is the IAS 16 thing, right? This does not have to include in this. So what we do is, out of the net profit, I told you from dividends, how are dividends paid? This is the profit that's left, right? After deducting all the expenses from the start, this is the profit that's left. So from 36,000, we'll pay out how much dividends? These ones, 21,000. 21,000 will be paid. And what will be the final answer? 15,000. This will be the final answer. Let's check it as well. Yes, you can see 195 is 15,000. This is correct answer over here, 15,000. Okay, right? Now 196, let's look at this as well. Which of the following items would not be included in the statement of changes in equity? All right, let's see. So in the changes in equity, although we have not studied this chapter as yet, but let's do this question, because one thing we know for sure, that in changes in equity, only the changes that happen in the capital or the equity section are recorded, nothing else. Okay, so which of the items will not be included? Let's look at this. Equity share capital, this will be included, right? This is a part of this. Revaluation surplus, yes, this is also part of this. Dividends paid, yes, it's also part of this. So the only thing which is not included is bank loans, you can see, because bank loans is not equity, right? It's a debt. So why would debt go into the statement of changes in equity? Because we are recording only the changes for the capital, for the equity section. So that means only thing that will not be included will be bank loans over here. Okay, got it. Now 197, this is the last question. Which of the following statements about preference shares is true? Let's see. All preference shares are classified as liability in the statement of financial position? No, absolutely wrong, because only redeemable preference shares are treated as liability. The irredeemable are treated as equity. Remember, right? Now let's look at option B. irredeemable preference shares are classified as liability and redeemable are classified as equity. No, it's the wrong. It's the other way around. It has swapped them. Irredeemable are actually equity, but it has written irredeemable as equity. So this is wrong. Okay. All preference shares are classified as equity. No, not at all. Only the irredeemable are classified as equity. Now, only D option is left. This will certainly be right over here. So irredeemable preference shares are classified as equity. Yes, absolutely right. And redeemable preference shares are treated as liability in the financial position. Yes, this is right. And this is the treatment that we studied in the chapter. Okay, so remaining questions after 198 till 205 you can try and let me know if there is any issue. Okay, and this chapter is well ended over here, and we will start hopefully with the next chapter, the next topic in the next class. Okay.